Hey everyone, welcome back to Corporate Dakota. Today we're diving into how the popular US government money market fund has been doing. Let's just say their latest report has some interesting numbers, especially when it comes to how they manage your money. So this whole report is about the popular US government money market fund LLC. It covers their financial year ending on June 30th of 2025. Think of it like a financial checkup for this fund, showing where the money came from, where it went, and what they invested in. As of June 30th, 2025, the fund had a massive $982,855,223 in total net assets. That's almost $1 billion. It also lists 9 portfolio holdings, meaning they've got 9 main investments that make up the bulk of the fund. And how much did it cost to manage all that? Well, the investment advisory fees paid amounted to $1,717.17, $81.10. That's a pretty significant chunk, and it's what the company that manages the fund gets paid for its expertise and services. Now, let's get to where the money is actually invested. The top holding as of June 30th, 2025 was something called Federal National Mortgage Association with a maturity date of July 2nd, 2025. This one alone made up 25.5% of the total investments. That's a big chunk of the fund tied up in this one asset. Next up, we see US Treasury bills maturing on July 3rd, 2025. These accounted for 1997% of the fund's investments. US Treasury bills are generally considered very safe investments because they are backed by the US government. Following that, Federal National Mortgage Association again, this time maturing on July 7th, 2025, making up 13.04% of the portfolio. And then we have another US Treasury bill maturing July 1st, 2025 at 10.06%. You can see a pattern here. A lot of investments in government-backed or government-sponsored entities, which is pretty typical for a money market fund aiming for safety and liquidity. The report details the cost for different types of shares. For Class A non-withholding shares, the cost of a hypothetical $10,000 investment was $73, which works out to 0.72% of that investment. For Class A withholding shares, the cost was slightly higher, $80 on a $10,000 investment or 0.79%. And for Class A institutional non-withholding shares, investing $10,000 would cost you $74 or 0.73%. Lastly, for Class I institutional withholding shares, the cost was $81 on $10,000, which is 0.83%. You can see the costs are pretty similar across the board, with the withholding shares being slightly more expensive. The fund also breaks down its investments by maturity. Around 69.3% of the investments mature weekly, excluding daily maturities. That means most of the fund's holdings are very short term and can be converted back to cash quickly. And 30.7% mature daily, meaning those are the most liquid assets in the fund. This structure is designed to give investors easy access to their money. Looking at the statement of operations for the year ended June 30th, 2025, the fund generated $2 in net investment income. That's the money earned from its investments after paying expenses. On the capital share transactions side, there was a lot of activity. For Class A non-withholding shares, the fund saw sales of $1,885,562. That's a huge amount of money coming into that share class. Class A withholding shares also saw significant inflows, with $1,355,199 sold. However, there were also redemptions, meaning people taking their money out. For Class A non-withholding shares, in Fercine, $447 were redeemed, so a lot of money was moving in and out of this class. Similarly, Class A withholding shares had redemptions of $1,144,208 down $411. It looks like there's a lot of churn in these share classes, with investors actively moving in and out. The financial highlights for Class A non-withholding shares show net assets at the end of the period at $527,881,000. The total return for the year was 3.89%, and the net expenses ratio was 0.72%. This means for every $100 invested, 72 cents went to fees. For Class A withholding shares, the net expense ratio was 0.79%, a bit higher. Their total return was 3.85% for the year. Class I institutional non-withholding shares had a net expense ratio of 0.73% and a total return of 3.90%. And Class I institutional withholding shares had the highest net expense ratio at 0.83%, with a total return of 3.60%. It's interesting that even with these slight differences in cost, the total returns are pretty close, all hovering around the 3.6 to 3.9% mark. The total investment advisory fees paid by the fund for the year was $1,717,810. This is a significant expense for the fund's investors. Interestingly, the report also mentions fee waivers. For the year ended June 30th, 2025, there were $133,777 in other waivers, which means some expenses were covered by external parties or the manager to keep costs down for investors. The financial statements were audited by Ernst & Young LT. They concluded that the financial statements present fairly the fund's financial position and results of operations. The audit fees for the year ending June 30th, 2025 were $56,100. Now here's a part that might raise eyebrows. The non-audit fees, which are fees for services other than the audit itself, billed by Ernst & Young for the fiscal year ended June 30th, 2025, were a whopping $17,591,505,910. That's more than 10 times the audit fees. While these services are separate from the audit, such a large amount for non-audit services can sometimes raise questions about auditor independence. The Board of Directors reviewed the investment advisory agreement. They considered the nature, extent, and quality of services provided by the advisor, the investment performance, and the fees and expenses. They concluded that the terms were fair and reasonable. They specifically looked at a Broadridge report which compared the fund's performance to similar funds, and they seemed satisfied with how the fund was performing relative to its peers. The independent directors also reviewed profitability information for the advisor. They looked at the advisor's revenues, expenses, and profit margins to ensure fairness in the fees charged. They also considered economies of scale, essentially if larger asset sizes mean lower costs for the fund. The board felt that the fee structure appropriately reflected these economies of scale even without explicit breakpoints in the fee schedule. Overall, this report shows a fund with substantial assets, investing primarily in short-term government and government-related securities. The costs associated with managing the fund are clearly laid out, and the auditor's report indicates a clean financial picture. However, the very high non-audit fees paid to the auditor are certainly a point to consider for any investor. It seems the fund is stable and operating as expected for a government money market fund, with a strong focus on preserving capital and providing liquidity. The returns are modest as expected for this type of investment. So what's my take on this filing? Well, the popular US government money market fund appears to be a well-managed conservative investment. Its heavy concentration in government-backed securities provides a high degree of safety, which is what you'd expect from a money market fund. The returns are modest as expected, reflecting the low-risk nature of its holdings. The significant inflows and outflows in some of its share classes suggest active investor participation, which is neither good nor bad in itself, but it does mean there's a lot of money moving around. The biggest point of interest for me is the large amount paid in non-audit fees to Ernst & Young. While not necessarily problematic, in the world of finance, transparency and auditor independence are crucial. A disproportionately high non-audit fee can sometimes signal a deep relationship between the auditor and the company, which is something investors should always be aware of. It's always good practice to ensure that the auditor's primary loyalty is to the shareholders and maintaining the integrity of the financial statements. The board's review of the advisory agreement and their satisfaction with the advisor's performance and fees seems thorough. They'd considered everything from industry standards to the advisor's own profitability. The focus on economies of scale is also a good sign that they're keeping an eye on cost efficiency as the fund grows. Ultimately, this fund seems to be doing exactly what it's supposed to do. Provide a safe place for money with easy access. However, investors should always look beyond the headline numbers and examine all the details like the auditor fees to get a complete picture. Alright, that's our breakdown of the popular US government money market fund's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.